welcome to episode 44 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria.
And my name is Tamanna Suria.
What we will cover on the podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as a merger arbitrage tool, check out insidearbitrage.com. Also, please take a moment to like and subscribe to this podcast on whatever platform you may be listening on.
We are continuing with our new format by focusing on 4 key stories, including a potential take private of the real estate firm Kennedy Wilson by its CEO and Fairfax Financial, the potential deal for an insurance and annuities provider company, Brighthouse Financial, coming to fruition, an insider purchase at a data center and Bitcoin miner, Core Scientific, and a large $1 billion buyback at an affordable luxury products company, Capri, representing a whopping 40% of its market cap at announcement. Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of the podcast for more details.
Let's get started with the deals in the works or a potential deal. Kennedy Wilson, a real estate focused asset management firm that has $31 billion in assets under management, received an acquisition offer for $10.25 per share from the CEO William McMorrow and Fairfax Financial. The company has a portfolio of apartments, retail, office, and industrial properties across the US as well as in parts of Europe. The stock jumped from $7.47 per share to $9.80 last Wednesday, but settled lower by the end of the week to $9.40, which is still quite a bit below that $10.25 offer that is being made. Kennedy Wilson also sports a dividend yield of a little over 5%. So in this case, you actually get paid to wait to see if this situation actually plays out. CEO William McMorrow, along with Prem Vatsa's Fairfax Financial, already own 32% of Kennedy Wilson and are willing to pay a premium of 38% on the company's last close. William McMorrow acquired Kennedy Wilson in 1988 and grew it from one office and 11 employees to the company that it is currently today. Kennedy Wilson recently announced the acquisition of an apartment communities portfolio from the luxury home builder Toll Brothers, which will increase the company's assets under management from $31 billion to $36 billion. When I first saw that news, I first thought they were talking about buying the luxury home builder Toll Brothers, but that's not the case. They're just buying a division of that company.
So, Fairfax Financial is often known as the Berkshire of Canada, so it's very interesting to see them get involved in this potential deal. What are your thoughts on the price being offered, though?
Yeah, before I get to that, you and I should someday make it out to go check out the Fairfax Financial annual meeting like we did with Berkshire Hathaway earlier this year. I've been thinking about that, and we own some stock in Fairfax Financial, so it'll be great to make that pilgrimage, if you will, at some point. Getting back to the valuation of this deal, investment management firms could be valued based on their AUM and the fees they generate. Things are more complicated with Kennedy Wilson because they hold a portfolio of properties which are likely held at a depreciated value on the balance sheet, and they also make loans, often construction based loans. So 75% of their revenue comes from rental properties, and they could be considered in some sense a diversified REIT, although they don't have a REIT structure. If you think of them as a REIT, then you could look at what multiple of AFFO investors are willing to pay for diversified REITs, which is usually not very high. AFFO, as you know, stands for Adjusted Funds from Operations, a term favored by REIT investors that adjusts for the high depreciation costs most REITs incur, as well as adjustments related to the acquisition or disposition of properties. So instead of thinking of it in terms of AFFO, if I were to think of it in terms of the AUM, which they like to report, without the Toll Brothers transaction, the CEO and Fairfax are willing to pay about $46 million per $1 billion of AUM. If you include the Toll Brothers transaction, then they're essentially willing to pay $39 million per $1 billion of AUM that Kennedy Wilson holds. Given that this is a real estate company that also makes construction loans, there's a significant amount of debt on the balance sheet, which is offset by those loans and the property portfolio that it holds.
Yeah, all those factors definitely makes this deal a little bit complex to figure out, especially in terms of trying to figure out how the company should be valued.
Indeed, maybe the second potential deal we should discuss is probably a simpler company in some sense. So the second deal we wanted to talk about is Marvel Technology, which is not the company that Disney acquired a long time ago to churn out an endless stream of superhero movies, but a company that actually helps giants like Amazon and Microsoft build custom chips. At this point in time, I think custom chips for AI is probably hotter than the superhero movies the other Marvel generates. We wrote about Marble technology earlier this year and added it to our model portfolio as a picks and shovels play on AI as the company builds chips that might not be used to train AI models like NVIDIA does, but they can be used for inference, which is a nice way of saying that they will process the questions you pose to AI models at a very low cost. The stock has been on a roller coaster ride this year, and its larger rival Broadcom continues to perform better, at least as far as the stock price is concerned. There was news last week from Bloomberg that SoftBank Group explored a potential takeover of Marvell Technology earlier this year. Marvell has seen its stock drop quite sharply during the April tariff worries, and I can see how SoftBank probably tried to capitalize on that weakness, and I'm glad they didn't exactly end up buying the company at that low price.
Let's transition over to a couple updates about existing deals, starting off with Papa John's. We spoke about the company just 3 episodes ago, talking about how Apollo Global was rumored to submit a bid to take the pizza chain private at around $64 per share. Now, earlier this year, we had already discussed Apollo Global partnering with the Qatari investment firm, Earth Capital, to take the company private. But given that Earth was still trying to figure out financing, it seemed as if Apollo was willing to go for the deal alone. And when we last discussed the company, Papa John's was trading at around $52 per share, and then it traded as low as $39 per share since the initial rumor back in June. The stock price dropped once more this week and has settled at around $41.08 per share after it was announced that Apollo had pulled their $2.1 billion deal or bid for the business. Now, Reuters reported that while some PE firms are still interested in Papa John's, they do not think it is worth $64 per share, which represented quite a premium, given softening consumer demand for fast casual food. Moving on to yet another deal update, we spent a lot of time in prior podcast episodes discussing the Warner Bros. Discovery proposed spin-offs and then Paramount Skydance's potential bids for the business, but we wanted to provide a quick update on a few other businesses that have entered the ring. Comcast has reportedly retained financial advisors and then gained access to financial information as it explores a bid for Warner Bros. Discovery's studio and streaming businesses. Now, this news follows Netflix entering the bidding ring after hiring the investment bank Moelis to evaluate opportunities. Now, Netflix CEO has stated that the company is typically known as more of a builder rather than a buyer, but it is still planning on evaluating acquisitions based on criteria such as the size of the opportunity and whether or not it would strengthen the company's entertainment offerings. Now, unlike Paramount Skydance, which was interested in the whole company, Netflix would only be interested in the studio and streaming business and not the cable television networks, which includes networks such as CNN, TNT, Food Network, and Animal Planet. Comcast, as mentioned earlier, is very similarly only evaluating media assets that they believe would be complementary to its existing business. And the company CEO has stated they are rather unconcerned about securing regulatory approval, outright stating that things are more viable than some of the public commentary that's out there.
As a Netflix shareholder, I would much rather prefer that they continue growing organically, but maybe they're hitting the upper limits of what's possible with organic growth or branching into things like gaming. And that's why they're considering the wonderful library and the studio offerings that Warner Brothers brings to the table.
At the same time, though, the Lionsgate spinoff is sitting right there as a much smaller studio and streaming business. As a Lionsgate shareholder, I would much rather they opt for that deal instead than the complex mess that Warner Bros. Discovery is at the moment. But we'll see how it all plays out.
Don't get me wrong, as a Lionsgate shareholder, and we hold probably more shares of Lionsgate than Netflix, I would much rather they buy out Lionsgate. But I have a feeling that'll happen down the road at some point. It's just that something we've thought might happen for a while, but hasn't happened yet.
We'll see. Moving on to the last of our deal updates that we'd like to focus on this episode. When we last talked about the Pfizer and Metsera deal, we talked about Novo Nordisk jumping into the mix with a superior proposal, potentially setting up a bidding war between the two businesses. But rather than increase their bid, Pfizer instead filed a lawsuit against Novo over the deal, arguing that their offer carried substantial regulatory and executional risk. A few updates have developed since. Pfizer has filed a second lawsuit claiming that Novo Nordisk's plan to buy Metsera is an anti competitive move meant to protect its dominant position in the GLP-1 market by stopping a potential US rival before it can partner with Pfizer. Now, for some context, the initial deal with Pfizer was for $4.9 billion, or $47.50 per share, with a CVR worth $22.50 per share. Novo came in with a $6 billion deal for $56.50 per share, and then a slightly smaller CVR of around $21 per share. After the second lawsuit, Novo came back with an even higher $10 billion deal that bumped the initial cash offering up to $62 per share, roughly, and then bumped the CVR up further to $24 per share. The revised deal followed that very same odd two-step structure that we discussed in our very last episode, which you can listen to for a little bit more detail. Pfizer responded with a $60 per share offer, but then decreased the CVR down to $10 per share. At the same time, the FTC stepped in and stated that the Novo and Metsera deal would violate the HSR Act if it was consummated without first filing for pre-merger review. On the other hand, the deal with Pfizer was far more likely to pass regulatory scrutiny, given that Pfizer doesn't have an existing dominant GLP-1 franchise just yet, unlike Novo. Pfizer and Novo continued to bid up the deal until eventually Pfizer came out with a final offer of $86.25 per share, consisting of a $65.60 per share offer in cash, and then a CVR entitling shareholders to additional payments worth up to $20.65 per share. Metsera accepted this offer, and then Novo stepped back due to those aforementioned regulatory concerns. But I think this is a great case study on how investors can very much profit from a bidding war with two entities that are very much willing to pay whatever they need to acquire a developing and exciting franchise of GLP-1 drugs.
This was giving me flashbacks of JetBlue and Frontier fighting for Spirit Airlines and JetBlue winning, but it turning out to be not the best kind of victory because the regulators did block that deal. And if Novo had continued, they might have run into a similar situation. So, in some sense, it's good for Metsera shareholders to see that the Pfizer deal did come through, although at a much higher price than initially they expected it to.
Absolutely. We'll transition over to newly announced M&A this week, and one of the larger deals announced this week was the $48.7 billion acquisition of the consumer health company Kenvue, best known for brands such as Band-Aids, by the consumer goods and personal care company Kimberly-Clark. The deal is structured as a cash and stock deal where Kenvue shareholders will receive $3.50 per share in cash, as well as nearly 0.15 Kimberly-Clark shares for each Kenvue share held, for a total consideration of around $21 per share. Now, Kenvue was spun out of Johnson & Johnson in mid-2023, and the stock is down about 22% post-spin, while Johnson & Johnson stock is up about 16% in a similar time frame. As is typical of most spinoffs, the company has a fairly sizable debt balance of $9 billion, but compared to a market cap of $32 billion, I wouldn't call Kenvue super leveraged by any means. Kenvue being acquired by Kimberly-Clark, it makes perfect sense strategically, especially considering that Kimberly-Clark already owns brands such as Kleenex and Huggies diapers. It'll be interesting to see Kimberly-Clark's stewardship of the various Kenvue brands going forward, though.
Another new deal that is worth discussing, but that only happens to be 1/10 the size of the Kenvue deal, was that of life insurance and annuities provider company Brighthouse Financial. Abu Dhabi-based Aquarian Capital is acquiring the company for $4.1 billion dollars, or $70 per share in cash, a premium of over 35% over the stock's last close. While an insurance and annuities provider might sound boring, there were a lot of interesting twists and turns with this one that caused us to write about the company multiple times over the last couple of years. We first covered the company in one of our monthly Buyback Wednesdays articles in December 2023 after Brighthouse announced an additional $750 million buyback program that represented, get this, one fourth of the company's market cap at announcement. So 25% of the company market cap they were willing to buy through a buyback program. Not only was the company announcing such a large buyback, it had also retired 42% of its stock outstanding during the prior 4-year period. So this is one of those cannibals or buyback machines that was announcing new buybacks and actually executing against that. The company had been spun out of MetLife in 2017 and was a buyback machine since then. Last month, my friend Sailesh also discussed income opportunities associated with the company's preferred shares and unsecured debt, as well as a trade that involved buying stock and writing cash secured puts that generated an attractive return in an article that he wrote for Yield Guru.
The name actually seems quite familiar to me. Wasn't this also a rumor deal, or as we like to call it, deals in the works situation from earlier this year?
Yeah, beyond the company's buyback activity, another reason we were paying attention to the company was because we were tracking it, as you said, as a potential deal since the beginning of the year. During the potential sale process, which we covered extensively in our Deals in the Works section of Inside Arbitrage, firms like Sixth Street, Carlyle Group, TPG, Nippon Life Insurance owned Resolution Life Group, and insurer Jackson Financial submitted varying offers. While they were in talks with these potential acquirers, Blackstone, Apollo, and Carlyle weighed bids but eventually dropped out of the process. As the talks progressed, Aquarian started to come on top, with TPG only interested in certain parts of the company. Founded in 2017 by former Guggenheim Partners executive Rudy Shahay, Aquarian has expanded through a series of life insurance acquisitions, beginning with investors' Heritage Life Insurance Company in Kentucky. Aquarian has about $25 billion in assets, and its backers include Redbird Capital Partners and Mubadala Capital, the asset management arm of Abu Dhabi's state fund. The takeover talks between Brighthouse and Aquarian went on for months and were repeatedly delayed. David Einhorn's Greenlight Capital, which holds a nearly 5% stake, encouraged the board to follow through on its reported decision to evaluate strategic alternatives and accept the offer apparently been made by Aquarian. By October, the talks with Aquarian had cooled off, and Sixth Street had again risen as a potential candidate. Sixth Street had offered Brighthouse roughly $55 per share, but this was at a discount from Aquarian's bid, which was already at the $70 mark. The only reason the talks had stalled then was because the board did not like the funding proposal tied to the Aquarian final bid. And it looks like Aquarian has figured that funding side of things out by working with not only sovereign wealth funds, but also several investment banks. The deal, which is expected to close in 2026, currently sports a 6% spread or about 5% annualized, given how long it's expected to take before it closes.
That's interesting. I know we were talking about bidding wars earlier, but I think this is a good example of how, even before a deal is announced, they go to multiple potential buyers. There is a bidding war sometimes behind the scene. And as we just saw, Aquarian came in, Sixth Street came in. There were a couple other potential acquirers for this business before the deal eventually came to shareholders, which kind of emphasizes that if a bidding war happens after the deal is announced, there's something really interesting going on at the business.
Absolutely.
We'll move on to the spin-off section of our podcast then with a very, very brief update on an upcoming spin-off that's been announced since March of last year. Unilever, one of the world's largest consumer goods companies, is expected to complete the spin-off of its ice cream business, Magnum, on December 6th of this year, following a delay caused by the US government shutdown. The spin-off has faced quite a lot of opposition, not due to their Magnum ice cream or Breyers brands, but instead due to the Magnum ice cream company's subsidiary, Ben & Jerry's. Ben & Jerry's had claimed in March that Unilever had illegally ousted its CEO, over the support for the board's progressive activism. And then by September, Ben& Jerry's co-founder and namesake, Jerry Greenfield, had also resigned. Ben& Jerry's and Unilever have been engaged in various controversies and legal battles since 2021. And just a few days ago, the Magnum Ice Cream Company concluded that the chair of its Ben& Jerry's independent board no longer met the criteria to serve after internal investigations, removing him from his position. The steady stream of executives leaving this business as the spin-off date nears is a bit of a concern for investors to keep in mind.
Absolutely. Speaking of spin-offs, DuPont has completed the spin-off of its electronics business called Qnity Electronics, effective November 1st, 2025. Qnity started regular way trading on the NYSE on November 3rd, and the business is so large that it's going to be actually part of the S&P 500. DuPont shareholders received one Qnity share for every two DuPont shares held as of October 22nd, with 209 million Qnity shares distributed. The company operates in two segments, with their semiconductor technologies division generating 54% of its Q3 2025 sales and their interconnect solutions segment generating the rest. Third quarter 2025 net sales were up 11% year over year to 1.275 billion, and the company raised its full year guidance to $4.7 billion from its previous guidance of $4.6 billion. They expect to grow organic sales about 6 to 7% through 2028 and adjusted EBITDA at about 7 to 9% while maintaining a target net debt leverage below 3 times EBITDA. So overall, it seems to be an interesting business that is growing a little bit above the rate of inflation, but not necessarily all that exciting. Speaking of exciting stuff, let's talk about the stock buyback that actually was quite exciting. The company that gives merger arbitrage focused investors like me PTSD is back in the news with the affordable luxury products company Capri announcing a $1 billion share buyback program that represents more than 40% of the market cap at announcement. So while we were talking about Brighthouse Financial announcing a 25% of their market cap buyback announcement, the Capri one goes even further at 40% of the market cap. Capri is the company that until recently used to own the brands Michael Kors, Jimmy Choo, and Versace, and went through a long merger process with Tapestry, which is the company that owns brands like Kate Spade and Coach, and that deal was ultimately killed by the FTC. We have a post-mortem on Inside Arbitrage that goes over all the gory details of this failed merger. The deal price for Capri was $57 per share in cash, and the stock was still trading above $40 per share right before the deal failure caused the stock to drop 48% in a single day to $21.28 per share in October 2024.
That's a fairly significant drop and a key risk that many merger arb investors often worry about, the stock price dropping after a failed merger. We sometimes see a rebound in the stocks of failed deal companies after forced selling by merger arb funds subsides. Was this the same case here? Is that what played out? Did Capri's stock price recover by any chance?
Not quite. After a brief dead cat bounce, the stock continued heading lower and eventually bottomed in the low teens earlier this year. Since then, the stock has rebounded back to the low 20s as fears about tariffs have subsided a little, and the company managed to ink a deal with Prada to acquire its Versace division for $1.375 billion. Capri's market cap is just $2.63 billion, but its enterprise value is $5.39 billion because of debt on the balance sheet. They have about $1.3 billion of net debt and $1.6 billion of lease liabilities. And I'm surprised that they've authorized such a large buyback instead of using the Versace sale cash to pay down debt and turn around their remaining two brands that have been significantly hurt by heavy discounting activity over the last few years.
Moving on to the insider section of this podcast, we've spent quite some time on the podcast discussing the failed merger between CoreWeave, an AI cloud computing company offering access to powerful infrastructure like NVIDIA's GPUs, and Core Scientific, a digital infrastructure company that primarily mines Bitcoin but has expanded to operate large scale data centers across the United States for high density colocation services. The deal announced this year was for $9 billion and was an all stock deal with no collar mechanism, meaning CoreWeave's stock began to drop, and then therefore, Core Scientific's valuation became more and more compressed. The deal started out with the spread eclipsing 40% just 2 days after it was announced, but eventually the spread ended in negative territory because investors widely expected the deal to fail and saw value in Core Scientific as a standalone business. Core Scientific announced at the end of October that the deal had in fact failed after shareholders failed to vote for the deal and the company did not receive the required number of votes for the merger agreement to complete. So this week, we were quite fascinated to see an insider of Core Scientific make a small purchase of $100,000. Core Scientific stock has skyrocketed since the announcement of the merger and then climbed more after the deal termination as investors have placed a lot of hope in this Bitcoin miner.
Is calling the company a Bitcoin miner fair though? Aren't they undergoing a business transformation at this point?
Yeah, that might be the other part of the thesis that factored into the decision by a director this week to purchase shares of Core Scientific. While Core Scientific currently derives a majority of its revenue from earning Bitcoin and other digital assets for their own accounts, they've started to pivot to increase revenue derived from the high density compute. From 100% cryptocurrency revenue in 2023, the company is targeting 60 to 70% of revenue from HPC hosting in 2026, a shift that's driven by superior economics, contracted cash flows, and then the timing of the AI infrastructure gold rush. HPC hosting currently generates $1 to $4 million per megawatt annually, compared to roughly $1.1 million per megawatt for Bitcoin mining, with superior margin stability as well. Bitcoin mining gross margins actually turned negative for a moment in Q3 2024 as network difficulty and post halving economics compressed profitability. Similarly, in Q2 2025, Core Scientific's Bitcoin mining revenue dropped by more than 50% overnight due to halving. And halving is a process where Bitcoin rewards are cut every few years, with the next expected to happen in 2028. The strategic rationale for the CoreWeave and Core Scientific deals centered around vertical integration. So, as Core Scientific's largest customer with an existing $8.7 billion hosting contracts over 12 years, CoreWeave very much sought to own rather than lease data center infrastructure, eliminating $10 billion in cumulative lease payments. Now, despite the failed merger, Core Scientific still maintains its commercial partnerships with CoreWeave. The agreement is also beneficial from a capital expenditure perspective. CoreWeave funds the majority of conversion capex for Core Scientific, which is used to convert Core Scientific's existing Bitcoin mining data center sites into high-density AI and HPC facilities. These investments are credited against hosting fees at a maximum of 50% of monthly payments until they are repaid. So it's not entirely a free bonus from CoreWeave to Core Scientific, much like the Apple to Globalstar capex spend was. But there is some sort of amount being paid back. However, in the first 9 months of 2025, CoreWeave actually funded 80% of total capital expenditures for Core Scientific, which makes it quite a lucrative deal either way. Overall, Core Scientific is a business in transition that is subject to the whims of both the AI bubble and the volatility of Bitcoin prices. It could be a good proxy for investors who are looking to get exposure to both of these names, but that ride is going to be a difficult one, and then something that I personally am going to be staying away from.
As you were discussing this whole situation and the fact that CoreWeave was willing to pay the capex for Core Scientific, I was very much reminded of the Apple and Global Star deal structure. But that is so much more simpler in some sense to model that structure as well as what the potential for Global Star might be compared to what Core Scientific is going through right now. And that might be part of the opportunity. Maybe it's not just these two themes of Bitcoin and AI. Maybe there's significant value here downstream that investors might not be easily picking up on. To wrap things up for this episode, let's talk about a C suite transition. Used car retailer CarMax announced last week that it was terminating CEO William Nash effective December 1st, 2025, before the company reports third quarter earnings on December 18th. So, this termination, keep in mind, this wasn't a resignation to spend more time with family. And its timing of the termination is certainly interesting, especially since it comes at a time when used car retailers are seeing signs of pressure, especially on the low end of the spectrum. Mr. Nash served as the CEO of CarMax for almost 10 years, and during his tenure, the stock was down 43%. Over the same time, AutoNation, which is also a car retailer but focuses on new cars, is up nearly 200%.
And with that story, we will conclude episode 44 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this podcast today, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions. Thank you.